What's up, guys? Today we're going to be talking about crypto to crypto liquidity pools and how you can set up your first one. My name is Richard, and if you want to earn passive income from your crypto, or if you've been yield farming for a while, then this video is for you. So the goal of this video is to share my process, and hopefully that would help you make more money while limit the risk that comes with liquidity pool yield farming. And the plan is to look at the big picture framework and break down some positions to give you examples of what I did. So before we begin here, if you look at my current liquidity pool portfolio, right now it's worth about $88,000 in liquidity. So the dollar profit and loss is pretty nasty, right? Almost $37,000. Because the alt market has been retracing for quite a while, it's starting to recover a bit. And if smaller cap alts and Ethereum is pumping again, this would probably flip positive pretty quickly. So you can see the earnings here is beating impermanent loss, $9,700 something dollars, and $7,000 something dollars of that is beating impermanent loss. So better off than just holding the assets I have. And I'm earning about $3,000 to $4,000 per month right now with my current positions. And if you benchmark it against just holding ETH with my current open positions, you can see I'm still up about 2.3 something Ethereum. So let's dive right into the main big picture framework here. So you're kind of starting from the bottom of the pyramid, right, in terms of importance, and when you're trying to enter into a new crypto to crypto pool. So kind of a funny acronym here, ARS with two S. And the most important part of this pyramid, the base of it, is the asset selection. So this is important because if you provide liquidity for assets that are not good to hold in the long term, then a lot of times you're going to lose money. And if you're accumulating crypto that is worthless, right, then you're not going to make money in the long run. The next leg up is relative strength. If you compare it against ETH, Bitcoin, or against USD, similar projects, you want to make sure the relative strength is good. For example, if you're providing liquidity for Ethereum and some other altcoins, if the altcoin is not outperforming Ethereum, then you're kind of bleeding out against Ethereum over time. It's highly likely you're going to lose your ETH over time. So in that case, you might as well just be holding ETH, right? So the next is the sizing. It's similar to trading. You don't want to go too heavy on a position. If you're providing liquidity for like higher cap stuff like Ethereum, Solana, Bitcoin, then like a heavier size might make sense. But if you're going down like the list, like below the top 10, top 50, then this becomes really important. You don't want to be oversized if you can help it. Then we're going to look at setting ranges next and the entry. So all of this is important, but there's priority to it, right? If you don't get the bottom part right and you only got the top part right, a lot of times you might be losing money over time. Let's say you got entry and setting ranges right, but because you provide liquidity for bad assets, then like something bad happens to that asset, you might lose a lot of money. So if we run through the whole process really quickly here, the asset selection, I usually start from CoinMarketCap. You see a big picture overview of like different crypto coins. Let's say I want to learn more about Bitcoin, Ethereum, XRP, BNB. I could just click into it, right? Let's say I click into Solana. I scroll down here. You can see about Solana. What is Solana? Who are the founders of Solana? What makes Solana unique? And it even summarizes the white paper for you. So this is a great start. And then from here, you could look at, their actual website, white paper, the interview of the founder or the leaders there, or even other YouTube channel that does like the token analysis. But I think it's very important to do your own research so that you know like the fundamentals of the project. Like what are the tokenomics, right? What's the strength and the weakness of this project? If there's actual revenue, actual transaction growth, all of this is going to be important information when you're providing liquidity. So that's the short part of the asset selection. The next is relative strength. So here, if I look at SOL to US dollar, you can see SOL is at a relatively cheap price compared to most of last year, right? And if you zoom out to the weekly chart, maybe you could argue that it might drop further, but for the US dollar terms, in my opinion, it's not as important as the Solana to other crypto terms. For example, Solana to Ethereum. If you look at our weekly chart here, relative strength is basically like, okay, how is this token performing against Ethereum? It means that like 1 SOL equals to 0.06622 Ethereum right now. And if you guys look at the trend since October 2023, it's been on an uptrend. So since that point, you would be outperforming Ethereum if you held purely Solana. So this is important because I don't want to be providing liquidity for tokens that are underperforming Ethereum if I'm entering the position with Ethereum or if I'm basing my portfolio performance on Ethereum, right? Because if the token is bleeding out against Ethereum over time, it's going to be hard for you to make an Ethereum profit. Because let's say SOL drops sharply against Ethereum and you have a lot of Ethereum in this pool, then all of your Ethereum would be converted to SOL, right? And if SOL is not worth much compared to Ethereum, you're going to have less Ethereum than what you started out with. So that's relative strength against Ethereum, and it shifts all the time. If you look at SOL to Bitcoin here, you can see Solana outperformed Bitcoin in the last alt season, retraced quite a bit here, consolidated, and then outperformed quite again. And then we're seeing another correction right now. It's very important to look at these charts, and it's a mistake to just be looking at just the US dollar chart. So the next part is the sizing. If you look at my current open liquidity pool position right now, you can see Solana and ETH and Pendle and ETH. I put in quite a lot of asset compared to other pools because these are larger cap projects with lower risk compared to something like Arrow and ETH or Mog and ETH, which, in hindsight was a pretty good decision to go lower, right? Because it's not doing well right now. It would probably flip into profit when alts are pumping again or when base gains more traction. But either way, sizing saved me a lot from the loss, right? And I was lucky enough to put more size onto the pools that are doing well right now. And if you look at my position weight breakdown, you can see ETH and SOL currently is like taking up 36.5%. Pendle around 15.7% that we just looked at, so over 50% in those two positions. And you can see an outlier here, Pixel and ETH takes up about almost 40% of my portfolio. Again, like this is much higher risk, but at the same time, I acquired Pixel at a lower price and I've been providing liquidity for these tokens for quite a while. So over time, I've built up this position. And if I were to enter into my positions today, I probably wouldn't have that much Pixel and ETH, right? Because inherently it's more risk. And if you look at Arrow and Mog, it's only 8 to 9% of my portfolio. We want to try to, make profit with all of our pools if possible. But again, it's not a big deal if you lose some and then you make some from the other pools. So sizing, really important. The next part is setting ranges. So I released a video last week on how to set ranges, but the short version of it is basically you want to start from the weekly chart. And I like to use the weekly chart because it gives you like a longer trend and longer term mindset. You're not just looking at, okay, how is SOL gonna perform against Ethereum in these few days or months. You're looking at, at least 6 to 12 months or a few years. So my main theory behind this pool here, I entered with Ethereum around 0.06. If we drop down to the daily chart, that's a pretty good entry, right? It's trading above that, so I'm in Ethereum profit just based on the liquidity in the pool, right? Not counting the fees. You can see here the orange lines are my top and bottom range. You can see my top range is tighter than the bottom range. The main reason why is because SOL has been outperforming ETH, right? But this also means that SOL is more expensive compared to ETH. So if I had like a bullish pool, for example, if I do this, if I drag my upper range all the way up there, my bottom range should be down here. Obviously, I would capture more of the upside, But also if like something bad happens, if Sol begins to reverse against ETH, then I would also lose much more ETH in that case. So the main thesis behind this range is that Sol has been outperforming ETH for quite a while, and maybe it's due for a reversal. You can see there's a big bearish divergence here on the weekly chart, and that usually indicates like a trend reversal. And it might take a while, right? It might take, months to play out. But either way, I'm happy to hold some Sol if this happens. And when it bleeds out against ETH, I would gain a lot of fees in the process. And if it continues to outperform ETH, I'm happy as well because I get more ETH than what I started here at 0.06. So setting ranges are very important, right? If you look at the weekly chart, you can see some people went in with a very tight range with the green bars that I marked out here. This is where the liquidity is most concentrated. But if there's like a big change in direction or if the trend continues, you can see these positions would be out of range quite quickly. And to be honest, I don't think it's very likely they're gonna stay in range for, months or a year or two in this very tight range. So setting ranges quite important. If you mess it up, it could still lose you money. And the entry is next. So if you look at my entry for the Sol and ETH position, I mentioned again, I entered at 0.06, which was pretty good in hindsight. But even if it drops, it's not a big deal. If you look at my Pendle and ETH position, my entry wasn't that good at around 0.00135, but you can see this pool is still doing well because the price of Pendle has pumped against ETH. So entry is important, but in my opinion, not as important as the other factors that we looked at, right? Like setting ranges, sizing, relative strength, and asset selection. Because over time, when you're providing liquidity, a lot of times we're looking at higher time frames and you're often in range for at least 6 to 12 months or longer. And if I can stay in range for quite a while, the entry becomes less important, right? Because I could sell, like take profits when the price is more expensive against ETH. I could compound my fees when the prices are low and kind of drag down my entry. But obviously, if there's opportunity to get in at a cheap entry, then that's what you want to take advantage of. So that's the whole framework. I think it helps to go through all these process before you enter into any liquidity pool position. It applies for like crypto to stable pools as well. If you're providing, let's say, ETH to USDC or Solana to USDC, but it's much more important when you're looking at crypto to crypto pools. So the next part of the actual execution is this set framework. You start with simulation, you then execute, and then you want to track your progress. So we're going to use Sol and ETH LP as an example here. If you look at the current liquidity pool, I usually start with revert. Here I can see all the pool age, right? The ranges they set and also the APR they have. So here I would typically want to look at like positions that are age. I could kind of like guesstimate my APR over the longer period. If I look at, let's say, these positions with like 143 days, right? And their range are fairly wide compared to like these tighter ranges here. So if we click into that 853999 NFT position, you can see these are like the limit prices. So you can see their exact range, right? When they deposit the pools, if they have withdrawn any or claim any fees. But here you can see they're in pretty nice profit here, generating about 55% APR on their capital and actually barely any divergence loss because the price right now is trading near what they deposited. So again, 143 days, pretty good performance out of this pool. And the next thing we want to look at is we hop over to Metrics Finance. This is the free version. I have the pro one. But even with the free one, you can see if I put in the min and the max price they have, I can see based on the last 30 days of volume, I might expect 29% APR if the liquidity stays at this current price concentration. So you can see it's a bit different from what it shows on revert because this is only past 30 days, and when this moves, right, you don't always get that peak liquidity concentration. So the next step, I want to hop over to Desmos to calculate my impermanent loss. Let's say the value of deposit, you deposit like 10 ETH, right? My prices upper and prices lower. You can see I put in basically what they had, right? The lower range and the upper range. The price of deposit, 0.067. Let's say the price now is also at 0.067. This is basically the scenario they had. They deposit near 0.067 and the SOL ETH price is also near 0.067. So barely any impermanent loss, and whatever they collected in fees on top is basically profit in crypto terms, right? So in theory, if they just stay in range and the price trade exactly the same place we are, and the position is in range for a year, if he's getting like 50% APR, then he's gaining like 50% profit in crypto terms, right? But this is where it gets interesting. Let's say the price of SOL pumps against ETH to like 0.095. You can see he would suffer roughly 12% of impermanent loss. So he's been in range for like 143 days, right? But let's just round it up to like half a year. So he would have made like 25% on his capital based on the APR, right? So half of 50% APR is 25%. If ETH and SOL pumps to like 0.095, he would suffer roughly 12% impermanent loss. And you can see the 25% we were just talking about will cover that, right? And I picked 0.095 because if we look back at our chart, that's roughly where the recent high was. And if we zoom out, we could look at the lower range too. Let's say the low of last year was around 0.032, right? So that's what I want to simulate next. Let's say the price goes to 0.032. So pretty big impermanent loss in this case, 33%. So for some reason, if SOL drops sharply against ETH, he would probably be better off just holding if he was in range for only 143 days, right? But if he was in range for like a whole year and gaining 50% APR, you can see 50% is greater than 32.8%, right? So he would probably be still net positive for the year. So let's compare that with my position, right? If you look at my limit prices and my min and max price is quite wide compared to the last one, 0.025 roughly and roughly 0.099. You can see I'm earning like roughly 19% APR. Not that high because the volume has been dropping a bit and also because someone put like a pretty highly concentrated liquidity pool around the current price, right? If these tight ranges get knocked out of range, and I do expect them to get knocked out of range eventually, then I would gain higher APR. But let's run the same simulation. So this calculator is a bit wonky. You might have to adjust it. Just hold shift and scroll your mouse wheel. You could click the background too to move it around. So if I deposit 10 ETH, right? Same situation, price now 0.067, 0.067 when I deposit it, just to compare it against what we were looking at. So in that last example, if price drops to 0.032, this guy would suffer like almost 33% impermanent loss. If we apply the same thing, 0.032, you can see I would only suffer roughly 20% impermanent loss. So much less impermanent loss. Again, you're trading like less fees for less impermanent loss, right? And if I go to the upper range where 0.095, I would have barely 6% impermanent loss, right? And if my APR stays exactly the same as before at 20%, then I'm beating impermanent loss by, let's say, like 14%. And this tool is great, and this process is great because it shows you like the exact risk you're taking on. And in theory, if the APR is greater than the impermanent loss over like 1 year, then you're beating just buying those two assets at the current price, right? And if we look at our current price roughly, it's at 0.067, and I deposit actually at 0.06, right? You can see my impermanent loss was only like 0.6% because the price hasn't diverged that much. And one neat thing here is like, let's say I deposit 10 ETH here at the time of deposit of 0.06. If the price goes to my upper range, you can see I would have roughly 11.13, this Y max here. That's the Ethereum I would have, right? And if it drops to my lower range, I would have roughly 221 SOL. And the last step we want to do is we want to backtest our position. So we go to create position, right? ETH and SOL. Select the same fee tier I had, put in the range I had, right? Let's say we use 10 ETH just for easier math. And when you run the backtester here, and you can see I would average about 0.112 ETH in the fees in the last 30 days. So if I analyze that, 0.112 times 12 divided by 10, that's only like 13.44%. I mean, it's beating staking, right? But this is fairly accurate based on the last 30 days volume. And the reason why is like, if you look at my position, the first few days was actually really good because like there's less liquidity concentration and the volume was high. But you can see the fees wasn't that great during the last 30 days. And as long as, these pools get knocked out of range, I would earn more fees, right? That's the main strategy behind it. And as long as my fees beat impermanent loss, I'm happy because I do want exposure to both Ethereum and Solana. And even if the price doesn't move much from this concentrated liquidity, that's also fine with me because I'm still earning like, 13, 20% APR, and I'm not incurring much impermanent loss, right? If it's staying in this range. So that's the simulation part of the process. A bit more complicated for crypto to crypto pools because you kind of have to like think in the quote asset term or in the terms of the asset you're trying to accumulate. In this case, I'm trying to accumulate my Ethereum. So that's why I base a lot of the thinking behind Ethereum, right? So the next part is execute. You could use tools like revert here, for example, to like let it swap for you into range right away. Or I could go to Uniswap and swap my ETH for Solana, right? And if I want to create a new pool, I go to pool and new. So here is ETH and SOL. I want to do V3, 0.3% fee tier. I picked V3 because there's not a lot of volume and data behind V4 yet. So just still waiting on that before migrating over there. And here the amount you put would depend on the ranges you set, right? I have ETH as my quote asset here. And let's say I'm putting in roughly $10,000, right? With these particular ranges, you can see on Metrics Finance, this is roughly the amount of SOL and ETH I would need. And if I put like 2.7884 here with like tighter range liquidity, you can see I need roughly 38.5 SOL. So a bit higher than what it shows on metrics because the price has probably moved a little bit. So once I have my asset, I would just enter into the pool. So that's the execute part, pretty simple. And the simulation is the most important, right? If you don't get this step right, then when you execute and track, it's not going to be as good. And to track my positions, I like to use both Revert and Crystal. For example, I could see my ETH profit and loss compared against just holding, right? So Crystal is nice too. You could see like the performance over time. But this is based all in US dollar, right? If my goal was to accumulate more Ethereum, then you're kind of out of luck there. You can see like the daily earnings, which is pretty good, and earning over 1 year. And you can see like last year when my portfolio wasn't doing that well, it was worth about like $55,000, like towards the low of my portfolio. And right now, even though the market is quite low, you can see I've accumulated almost $88,000 worth of crypto. So like some people think like yield farming is a scam, but I mean, I've been making it work, and hopefully you guys make it work as well. So those two tools are free, but the metrics finance tracking is also great. You can see like the fee projection based on like the past data since you opened the pools, compare it against holding. And if you click into the details against, for example, ETH and Pendle here, you can see like my performance against just holding ETH was quite positive. I would have made more just by buying 100% Pendle, but I do expect over time, like, all these four metrics are going to be positive. Basically, different ways to benchmark your progress. And the last part of this is I like to track my asset in the spreadsheet here that I've created recently. I'll share with you guys the link to the template in the description, but basically it gives you like a bird's eye view of your total asset. And if you key in the data in the yellow boxes here, the liquidity pool weight. And the reason why I made this is because I want to make sure that I'm not overweight in any asset, right? For example, you could see I'm pretty overweight in Ethereum, Pixel, and ETH here. And that's why I started using more of my fees to buy stuff like Bitcoin or Solana, kind of balance out my portfolio and my risk a little bit. So that's pretty much it for the tracking part. I will make another video on how to use my spreadsheet, but if anything, I think this is much more important for beginners to run through this whole process. And if you guys have a better process, do let me know in the comments. Or if there's any more specific questions, I could try to help you out when I see them. So be sure to check out the other videos on the channel. It's going to help you make more money and also avoid the same mistakes that I made. Thanks for watching. I'll catch you guys on the next one.